Good morning, traders. It is 8 a.m. Chicago time on Monday, the 20th of September, 2021. This is episode number 2076. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, looking at the markets, clearly a strong risk-off sentiment. This is the posture of the market this morning. The S&P is down 170 basis points, currently down 75 points at 43.46 or so, currently trading 43.46 and a quarter. This is a static sheet in front of you, made static just before the broadcast here. The Dow's off 632 points or 183 basis points. The NASDAQ really falling down 257.5 points, and the Russell is down 53.6 points or 241 basis points. We see the same in Europe with the Euro Stoxx 50 down 230 basis points, and in the DAX 255 basis points. Crude is also off. We see a climb, a rally in the 30-year and the 30-year bonds and the 10-year note. We see a rally in the Eurobond as well. So allocations into safer havens in the form of treasuries and metals, gold, silver, with copper being an industrial metal, not a store of value, also coming off. So gold, silver higher, copper off. We also see some real big selling in crypto. Again, as money moves towards safety, this is why we track the overall risk posture. On the earnings side, there's nothing pre-market that is major. After the market, we have Lennar, which is a builder, a real estate builder, and the biggest thing that's driving this today, one second. The biggest thing that's driving this is actually relatively stale news. The Hang Seng hammered this morning due to property bank stocks getting pushed by regulatory changes by mainland China. So the Hang Seng, which is where foreign investment really is concentrated, is much lower this morning. China is curbing leverage. And if you read about this, and I read a fair amount about this over the weekend, if you read about this, it seems like China is simply getting ahead of an over-leveraged market and is doing the right thing, it would seem, by cutting down on how much leverage builders and construction companies and property developers are playing into. That's not a political statement. That's simply saying that they recognize that for a long time now, that market's been incredibly over-leveraged, and they're stepping in to cut that down. So there's nothing new that I could find this weekend that would tell me that this is new news coming into the markets. Now, we have some really important releases this week. We do have the Fed decision at 2 p.m. Eastern on Wednesday, and the press conference at 2:30. And the market's going to look for the dot plot. They're going to see when this taper is going to take place and how many instances of the taper and so on and so forth. Then we have the BOE interest rate decision on Thursday and GfK consumer confidence on Thursday. Inflation rate out of Japan on Thursday at 7:30 p.m. And then Friday brings in the IFO business climate and that from Germany. And then Saturday we get the German federal election. Today Canada has its election as well. And today and tomorrow mainland China is closed. But in general, there isn't like a new piece of information that is driving this move down. And as a result, and I've talked about this now for a couple weeks, that there are some really big macro issues that are coming into play, and some of those were covered by Jeff Snyder, who was a guest on our macro program on Thursday. I definitely encourage you to catch that recording. He really laid things out in a way that could help everybody understand that inflation is probably transitory, and that this clamoring on to the Fed and what it'll do is not likely to be something that is sustainably going to hold the market. So overall, he thinks that it's all in the employment picture, really, specifically wages. So these higher prices or elevated input prices are likely transitory and so on. So with that being said, I'm not a macro analyst, but I'm going to tell you that this market is probably coming into a trough here. Is probably coming into a trough over the next couple of days. But on rallies, they're likely to be faded rallies, or rallies that might have difficulty regaining, as we have seen. We've been trained to see over the last few years, where we get these V bottoms and it goes right back and makes new all-time highs. I believe that with what I'm seeing and what I'm reading, it's going to be tougher to do that going forward. So trade what you see. You want to stick with whatever method you're using, and if your method does not incorporate high volatility type trading, this is not a market that you want to be active in. You want to be very, very selective. But to me, this is the market that provides the higher opportunity for a simple reason, and that is higher volatility creates more price movement. We are trading price, and therefore there's a higher probability of making higher profits, but also a higher probability of greater losses. So this is the type of environment, and I'm going to say this very clearly, this is the type of environment where if you're trading multiple contracts, you want to cut down and widen your stops. And if you're trading a mini, you have an opportunity to go to a micro. Forget that the micros and exchange fees cost more than the minis on a relative basis, so blah, 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 blah. Doesn't matter, because your losses are going to cost a whole lot more than commissions and exchange fees. So it's better to just kind of temper the ego a little bit and move down into micros and keep that risk under control by widening your targets and stops as volatility increases. We have to adapt to the market, okay? So that's it for the ES. The market is trending down 450, well, currently 465,000 contracts traded, extremely high volume. It's above 2 standard deviation volume over the last 252 days. The inventory is 100% below the settlement price of Friday, which was 44.2150. All of the volume occurred below the settlement price, and therefore the overnight inventory is 100% short. The range is 78 points, which again is extraordinary. It's about twice the first standard deviation, a little over twice the first standard deviation. So we're in second standard deviation territory with the range. So this is going to carry over into the open. The open is likely to be very active. The point of control has shifted down to 43.40, was at 43.6450, and the low is at 43.40. And I want to remind you that price limits, here are the price limits. This information is available to you right on the CME's website. Price limits for the ES during the overnight session are at 7% up and down, 7% during the day session to the downside only, and that price is 41.1150. There's a lot of room to that, and of course, if we do hit that, then we get a reset to the 13% price limit, which is at 38.4550. Not expecting that to get hit at all, of course, but It's something that you need to keep in the back of your mind. Okay. So again, I I implore you to cut back on your size and to take your highest quality trades. Be patient today. The market will likely come to you. Cut on size, increase your expectations in terms of targets and in terms of stops. You got to use wider stops, and you have to make up for that to keep your R factor constant as possible by moving into a wider um, target. Here's what was expected on Friday. Again, was looking for the market to pop through to 81. Remember, I talked about this 81, 82 is just a key resistance level that I was looking to sell all week last week. Not no go there. So I was looking for it to pull back, given the strength it came in with, pull back into the 56 area, and then push up to 81, 82, and then fall off. Friday was quad witching and expiration. The secondary scenario is to push up towards the 64 settle 64 65 area, and then to sell off into the 44 45. But there I'm leaning on the fact that it is expiration. The market's likely to be pinned, trading both way, lots of hedging going on still into the close and into options assignments into the weekend. And so I expected it to be quite tempered. What it did, however, was something that looked and acted completely differently. Here's what was actually in play. Let's remove some of these lines to make it nice and neat. The dark green is the prior low or prior high, which is way up here. The bright green is the open, and this is how the market traded. It pulled back to the 51. Remember, we looked for 56 or 50 to hold for a rotation up into 64, then push to 80 on the first scenario. The secondary scenario, push up into 64, 65, and then sell off into 44, which was up here. And that was completely off. I mean, a secondary scenario was in play, but the selling was more aggressive than expected. In fact, most of last week's trade was more aggressive than expected for expiration, for rollover and expiration week. It's just there's just no way to predict that. But in general, I'm relying on the past and how the market is traded before this. And yet last week was definitely a lot more volatile and actually provided more opportunity, structural opportunity, than expirations normally do, which is very unusual. So we found a high. We pull back to the 44.50. We put in a lower high, and it creates an opportunity to shoot for that 44.49 low for a break below into the point of control, which was around the 44 area. And then from there, we're looking for the prior session low at 33, which you can see here has a relatively weak-ish low. So this took out the prior session's low and actually extended lower. So after breaching the high the prior session, we ended up extending the low down, resuming our one-time framing up today if we continue to hold below. But we're definitely holding below with a big gap. And on Friday, we had kind of a funny looking profile where the distribution was mostly at the lower end with a weak low at 16 and a quarter double bottom. This was the way I define a legitimate double bottom, a double top, is two tops, two bottoms separated by a 15-minute bracket, which is what the pit brackets were. I'm looking for that to be an indication that the market tested, moved up, and came back to the same price. And if there's an excess, or if the price was too cheap in the first run, we wouldn't see the market return to that same price. And this is why we call it a weak low. Others call it a double bottom and consider it strong consider it strong or holding. To me, it's the opposite. It's a low that is likely to be taken out, if not in this session, at some future session. Here's what's happened since we opened back up. We open back up and we sell off immediately. And you can see most of the sell-off occurred right in the Asian market. The Asian market, we're used to it being sideways and kind of choppy and not much to feed in. Remember, mainland China is closed today and tomorrow, yet we get this big selling on the way down. We get way ahead of the mid and VWAP for the session. We leave Friday's low behind in the dust, and we never even tagged the prior settlement. And then the Europeans come in and drive this even more. So we end up pushing the low to 43.44, which is 100 points below the point of control of Thursday. And then we push a little more to 43.40, and now we've got a little bit of a relief rally. The delta, which is in play again, is definitely negative, and the volume overnight is a lot higher across all time brackets. It's a lot higher than it normally is, than the 20-day mean or the 20-day average. Okay, so a quick look at where we are in the overall picture, looking at this daily chart. This daily chart is simply the RTH only session. What have we accomplished? We've broken through what was a trend line that was running up like this, somewhere like that. It was a trend line that was kind of tying things together. We broke through this trend line. We have left behind that 43, 44, 27, 28 area. This is relatively weak. There's quite a bit of resistance above on retests, the key of which, of course, was 44.80, 45.01, and 45.10 above. But to me, it's a sell the rally type market right now, although it looks like we are gunning for the most recent low. Remember, these prices are back adjusted. The S&P prices, the futures prices are back adjusted, meaning that December's premium against September has been adjusted in. Your chart may show gaps on rollover. Mine do not, because we back adjust. So if your prices are a little bit different, that's the reason, okay? So today we are running away. This is a full session chart. Actually, let me switch it back. I was doing some studies earlier. Let's switch it back to the day session only, and let's cut it down to its most basic components. We did a good job falling last week, but then we got into this like weird kind of bottoming out and consolidation into the 44, 42, 43 area as a point of control, 44.50, playing in that zone quite a bit, and then we broke below that on Friday, and now we are breaking even lower from there. So overall, this looks like it's a pretty healthy, normal, what I would call a normal pullback. It's not a panicky type of thing, and overall, it's not something worth writing home about just yet. What we do know is that there's a fair amount of volatility, and then we have to take that into account coming into today, as I discussed. Let's take a look at what's expected for today so I can let you go prepare. Today is likely to be a relatively busy day. So I have to squish this chart quite a bit. So here's what we've got. I cannot, in high confidence, create scenarios for today. I can only outline the key areas to pay attention to. The key areas to pay attention to are highlighted with stock zones, but some of those are less important than others, right? So the first area to highlight is this 69, 50, 70 area in the 43 handle. Okay, that's the first one to point out. The next one to point out is this cluster here, and you can see the bounce off of it in the overnight session. This cluster that holds between 82 and 93. If it clears these two clusters, then we are likely back at the prior settlement at 44.2150, 2150. And then if we clear, not today, but over the next couple of days, because that's quite a bit of range on the upside, if we clear that, then we are looking at the MC point of control at 28 all the way up to this 34 as the next key resistance areas. Down below, there's a lot. Again, it doesn't make any sense for me to outline each level and what the prediction is likely to be. The market is completely out of balance, but not 41, 43.19. I've got the limit on my head, on the brain. 43.19, let's rewrite that so to avoid confusion. 43.19 is a key target below, where I'm expecting a bit of a bounce. There's a cluster of things that take place down there. These are your key, this is your key map. I'm not going to draw lines on here. It makes no sense. The market's out of balance. I'll leave you with that. Good luck, and I'll catch you tomorrow morning. Please mind your risk. If you don't mind your risk, you will not be here tomorrow, and game over for you. Good luck.